What is a trend? A trend simply refers to a market that is moving predominantly in one direction. A bullish trend would be a market that has been consistently climbing over time. The definition of a bullish trend is a market that is making higher highs and higher lows. A bearish trend would be a market that has been consistently falling over time. The definition of a bearish trend is a market that is making lower highs and lower lows. Trends can and do happen across timeframes. It is possible for a market to be in a bullish trend on the daily timeframe whilst being in a bearish trend on the 5-minute timeframe. Similar to support and resistance, we tend to pay more attention to the higher timeframe trends since they are giving us an insight into what the overall money flow is doing. By focusing on higher timeframe trends, we can make sure we are aligning with the predominant market forces. How do we identify trends? Okay, now we are going to start looking at identifying trends. We're going to look at 3 separate methods of doing this. So moving averages, Bill Williams fractals, and also DIY, do it yourself. And what we will do is we will look at some of the benefits and drawbacks for each method. Okay, we are on gold on the daily time frame, and we're going to start with moving averages. Moving averages are very common amongst traders for identifying trends, especially beginners. So what we're going to do is we are going to insert probably the most commonly used moving average for identifying trends, which is the 200 simple periods. We're going to add it to the chart. Now, what tends to happen is that traders simply load their chart and then they look at the market. If it is above the MA200, they look at the market as though it is in an uptrend and they only look for buy positions. If it is below the MA200, they see it as in a downtrend and they only look for sell positions. And then what they'll do is they'll use their support and resistance or whatever trading methods they have to look for those potential sell positions or buy positions. So the benefits are with the MA200, it's a definite answer as soon as you load up your chart. You can see instantly if the market is above or below the MA200, and then you know if you're looking for potential buys or potential sells. Now, the drawbacks are that looking at a moving average, it's a lagging indicator, and especially if you're looking at the 200 periods. So what we can see is it's using historic data to plot the average of where price has been sitting. And what we can see is as the market breaks down here, it's in a strong downtrend. However, it then starts to move into an uptrend. Strong uptrending movements. And the MA200 is not picking up on this. So you're missing all of these trending movements, and worse than that, potentially, you're trying to sell into this market over and over and over again when the market is clearly telling you that it's moving into a potential, or it is moving into an uptrend. Same thing for buys. So you're in an uptrend, but then the market starts to move into a downtrend, and potentially you're trying to buy and fight against the overall market trend. Now, traders use lots of different moving averages. 200 is one of them. What I will do is I'll also bring up the 50 periods, which is also very commonly used. The reason I'm using this one is because it's a little bit faster. It's only looking at the previous 50 candlesticks rather than 200. Now, what we can see with this is that we get price action where the moving average is just cutting straight through price action. And this will happen with the MA200 also. It's just not really happening on gold. When this is happening, it can become very confusing for traders, and it can start to cause lots of losses because suddenly the market is in a downtrend, you're trying to sell, but then suddenly the market's in an uptrend and you're trying to buy, and then suddenly the market breaks back into a downtrend and you're trying to sell. And what's happening is you're getting chopped into and out of trades because you think the market is moving into trends when actually all it's doing is ranging sideways. It can be very difficult to highlight or to identify this as price action is moving. It's easy when it's like this and you can see what's happening, but when you're doing it live, it becomes very difficult to pick out when a market is actually ranging. Okay, so what I'm going to do is just get rid of everything off this chart. We'll delete the moving averages also. So let's do it here, 1 and 2. And now what we're going to look at are Bill Williams fractals. So insert indicators, there's actually a section for Bill Williams and fractals. We'll just leave it as standard settings and press OK. Now what this is doing is, if you think back to the support and resistance video that we did, it's basically picking out the swings for you. So you can see the triangle at the top here. It's identifying this as the high of a swing. And then we get the triangle at the bottom. It's identifying the bottom of the swing. Then we get another one. And you can see on the way down we get one here, but then we don't get another high one, we get one here. So this becomes the low. Then we get another one up here, etc. This is a very useful tool for when you are learning picking out market swings. It's giving you, or it's helping to identify those swing points. So we've got the low, the high, the low, the high, the low. It's a very visual way for you to start spotting when a market is moving into potential trends. Now, the drawback of this is that it's not always perfect. It's not always going to identify the swings perfectly. Most of the time it's pretty good, but you're relying on an indicator to pick it out rather than doing it yourself. So let's just look here. We've got the move down, the spike up, the move down. Potentially you'll be looking at this as another swing and then the move down, and then a little swing here and then a move down. But the indicator is only picking out these ones here. In all honesty, it's not a major drawback, but the reason I like to point it out is because it's easy to become reliant on an indicator. And really what you want to do is you want to start learning to do it yourself. Yeah, there's really no better way to pick out trends than just doing it yourself. We've gone over how to pick out the triangles on the support and resistance video. And really, the best way for you to get better at identifying trends is to simply do it yourself. You know what you're looking for. You're looking for, on a downtrend, a low, a high, and then a market making lower lows and lower highs. So now you know, let's just say this is the only price action we can see. You know the market is potentially moving into a downtrend. So you want to start looking for those sell positions. Lower low, lower high, you're looking for sell positions. When does that stop being the case? When the market stops making lower lows and lower highs. So we've got lower low, lower high, but then what do we start doing? A higher low, potentially a higher high. So now what you do is you pause, and then a higher low, a higher high. Okay, the market is now giving us uptrending movements. We're now moving into an uptrend. We start looking for potential buys. Yeah, this is really the best way to identify trending markets. It's easy when you just look at a market, when you can see all the price data, say, okay, we're uptrending, we're downtrending, but you need to learn how to spot it as it's happening. So we've got the uptrending movements, make the high, then what do? We're no longer making higher highs and higher lows, we're making higher highs and lower lows because we've broken below the previous low. So now we pause and we wait to see what the market is doing. Now we've made a lower low and a lower high. Potentially, the market is moving into a downtrend. What do we need for confirmation? A lower low. And what does the market do? It comes down and then bounces again. This is not a lower low. Okay, it's just the market spiking down. We need to see nice clear triangles of movement, just like our support and resistance. And then we're making lower high, but once again, we're failing to make a lower low. So the market is doing what? It's ranging. And we want to wait again for the market to start moving into a trend. Then we make a higher high, higher low. But then what do? We fail to go anywhere, and we start to make a lower low. So we're just waiting for the market to move into that trending movements. Now, in the Decisive Package course, we go over this a lot. And there's extensive videos or much longer videos talking you through it and showing you how to do it on the markets. I'm showing you how to do it with forward testing also, so it's like you're doing it live on the market. But this is basically how you do it and how you practice. There's benefits and drawbacks to each. With this method,